Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Here is a sample of a volatility chart, but this is for EUI, the euro currency option that I mentioned earlier, available, one of ISE's FX options. And this is also a screenshot from TradeKing. Again, a free tool available. All you need to do is open an account. You don't need to fund it. Just open it up. You'll have access to all the tools that we have available. If you like what you see, deposit money and begin trading. As simple as that. The gold line here is a chart of the implied volatility fluctuation over the past year. The white line is the fluctuation of the spot price, I believe. I'm not sure of the exact semantics. Steve can correct me if I'm wrong. But this is based on the fluctuation of the underlying of EUI.
That's correct. It's just okay. We have that index pair value that mimics the spot rate, so that's exactly what you have there.
Okay, great. I wasn't sure if it was the actual or it was like a mimic, like you said, but fine. Great. All right, so as we mentioned, implied volatility, whenever you hear the word implied volatility, it means options. Options, options, options. And another thing to point out, the actual price chart of EUI is not on this page. Okay, I repeat, it is not on this page. You are looking at the fluctuation, the volatility of the price chart in the white line. You are looking at the fluctuation of the volatility, you're looking at the changes in the volatility, at the money volatility in the yellow line of the options. And as you can see, it looks like the volatility has been increasing in EUI over the past couple of months. And if you have a situation of increasing implied volatility, as we said, that's not conducive to the iron condor or any condor trade. So that would be another reason to hold off on this type of trade, regardless of what you may see in the actual underlying price action. All right, so here is a basic P&L graph or profit and loss graph of the condor that I showed you before. And this is the profit area up here. Actually, let me get some drawing tools. All right, so this is the profit area up here. But the potential loss area begins here, and it goes this way, right? And it begins here, and it goes this way. Okay, so you can see, when you see it like this, the profit area looks much, much smaller than the potential loss area. And that is true, okay? But the reason you're even considering this trade is because of the potential probability of success. And that's what was shown in the probability calculator screenshot. So, as I mentioned, I used the probability calculator for strike selection, and what I ended up with is the short put spread of the June 650, 670 puts, and then the short call spread of the June 790, 810 calls. The commission for this trade is about $46 to get in. The credit generated for each side of this spread is $1.70 on each side, and that total comes to $3.40. So that's the potential profit for this trade. Per share, right? I have 10 option contracts. Each one of those contracts represents 100 shares. I multiply that out. That comes to $3,400 right here. And then that's less the commissions of $45.80 gives me the potential max gain. Now, on the loss side, how do we calculate that? Well, we need that $340 credit that we calculated that's from the potential max gain, and we deduct that from the greater distance between the strike prices. Let me go up a minute. All right, so here the difference in the strike prices is 20 points between 650 and 670, and it is the same on the call side, 790 to 810. If they were different, I would use that 340 credit and deduct it from the wider side, okay, because the wider side has more risk. So in this case, they're the same, so it doesn't really matter. The potential max risk here is $16.60 per share. Okay, so when you multiply that out for 10 contracts at 100 shares per contract, that comes out to $16,000 plus the commission as well. All right, so this is what we're talking about. The short strikes is at the bend here. The long strikes is at this bend here. The screenshot I gave you for the first standard deviation move are these lines here and here, okay? And these are the break-even points here and here at expiration, okay? And the current underlying is somewhere right around this dot here today. So you want this stock, you want the underlying to stay between this range here, but it, in theory, could move as far as this much down or this much up. But keep in mind, even though this is the expiration, break-even points here and here, you're still going to feel a loss that's unrealized in your account. If you decide to exit that trade and the underlying has moved one way or another, even though it may be within the short strikes or within the expiration break-even points, it's not yet expiration, and you will take a loss when exiting that trade. All right, so this is what I was working up to before. Here's the reward and here's the risk. Okay, we have about $3,000 worth of reward and $16,000 worth of risk. If you don't know anything about it at all, at face value, that doesn't sound too great, right? But when you look at the potential return, when you look at the reward divided by the risk or the capital amount of the investment you would need to do this trade, that comes out to 20%. So that means that potentially you could earn 20% between now, within 50 days, right? This is not an annualized number. This is just talking about within 50 days. And if I could make 20% every 50 days, that would be fantastic, right? But when you see the numbers of trying to make 3,000, potentially lose 16 or 17,000, that doesn't sound so great, okay? So how do we evaluate this? We're talking about the probability calculator. Probability calculator is saying there's a 69% chance that I'm going to make that 20%. Okay, that's how these all three items fit together. But characteristically, what you need to know about condors in general, the risk and the reward definitely is limited, but the risk is much greater, as shown in that P&L chart that I gave you, right? There's a much wider area there, down to $16 that you could lose. And this is what wide condors look like. So because the max risk is so high, this is not the type of trade that you put on and forget it. I mean, to be honest, I can't think of any trades that are like that, but this is definitely not one of them. And so if the trade is not working out, you need to do something about it. You can't just stick your head in the sand and do the ostrich move, right? You need to adjust, you need to exit, you need to reevaluate, you need to do something. Doing nothing is going to definitely bring you to the maximum loss in this trade.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.